Well, Canada's inflation rate held steady in May, coming in at 1.7%, in line with expectations. So what does that mean for Canada's economy going forward? We're joined now by Robert Both, Senior Macro Strategist at TD Securities. And Robert, thanks for joining the show again.
Thank you, Anthony. Always a pleasure to be on the program.
All right, so we got the inflation numbers. What's your latest reaction to the numbers?
So, this feels like the first time we've had, somewhat of a boring inflation report for a while. The last couple, you've been seeing more pressure on core inflation metrics. You've been seeing some upside surprises on the headline measure as well. So to get something that was, as expected for both headline and core, it's a very nice change from the environment we've been in the last couple of months. Core inflation is still sitting at the upper limit of the Bank of Canada's target range. The two measures the bank follows most closely are both sitting at 3% on a year-over-year basis and a 3-month annualized basis. So right now, those 3-month annualized rates are telling us that there's not a whole lot of upward or downward momentum. If inflation were to, or if the month-over-month changes were to continue at this rate, we would essentially just stay here. So the Bank of Canada is going to want to see those start to bend lower. Inflation is still, uncomfortably hot from the Bank of Canada's perspective. But I think what we saw in this report that we're missing from the last couple were just those, signs of stabilization. So not only the CPI trim and CPI median, but other measures like the ex-food and energy index, the CPIX that the Bank of Canada used to put a little more weight on. Those are all, either slightly softer than April or holding steady. So, it's not the sort of decisive signal the Bank of Canada necessarily needs to see to declare that inflation pressures are contained. But it is a step in the right direction compared to the type of pressures we're seeing over the last couple of months. Okay,
so you mentioned inflation has stabilized. Let's break down some of the numbers. What are some of the things that drove inflation this last month?
Sure. So, on the headline number, we were unchanged. It was 1.7 last month. It's 1.7 this month, but there's always a lot of shifts under the surface. So the key drivers in May were we did see firmer core goods inflation, so things like motor vehicles, household furniture. These have been putting upward pressure over the last couple of months, and vehicle prices are running at their strongest inflation rate in nearly 2 years. So that is putting a little more pressure. And offsetting that, you've got smaller contributions from food prices. Obviously, the Canadian dollar has come back a little bit. That's taken some pressure off the cost of imported food products. And you've also seen more deceleration come through the shelter component. Now,
what's driving that deceleration? And did the changes in the basket weight, did that have any impact on the shelter prices this month?
So shelter disinflation, I guess, has really been ongoing for about a year now. Really, there are two key drivers there. One is on the rental and house price side. Canada has been seeing much softer rates of population growth since the government took action to reduce immigration. So that is reducing some of the demand for rental units for existing home sales. And you are seeing some of that seep through into CPI now. So rents have been a key driver of the deceleration. And then the other aspect is that as the Bank of Canada has been easing from 5% all the way down to 2.75 in January, that's been providing a lot of relief for those on variable rate mortgages. So those mortgage interest costs, which some had been pushing for the Bank of Canada to look through on the way up, are now starting to stabilize, and that is removing a key driver that pushed inflation so far above its target over the last couple of years.
All right, so putting it all together, what's your outlook for the Bank of Canada and interest rates?
So we will still get one more CPI report before the bank's next rate decision in July 30th. So this isn't necessarily the final say on the inflation outlook heading into that meeting. But even with the sort of stabilization, the progress, inflation is still tracking above their projections from the April monetary policy report. The bank thought headline inflation was going to average around 1.5% over the second quarter. Core would be between 2% and 3%. we're still tracking slightly above those numbers after today's report. But we do think that with the stabilization we've seen today, with a little more progress in the June CPI report we'll get next month, and then more importantly, just that more evidence of softer growth from tariffs and uncertainty can still pull the bank towards another rate cut in July. And we do look for 2 more cuts after that in September and October. The key is the data does need to cooperate to get there. If we're still seeing 3% core inflation rates into the second half of this year, and we don't see those broad headwinds to growth, then the argument for rate cuts becomes much weaker.